Tyler, we've already seen one interest rate cut from the Fed, and it's just about a given that we're going to see one, probably two more cuts before the end of the year. We have a couple higher yield dividend stocks that we want to talk about that we think now is a great time to be buying them.
Yeah. Hey, when yields go lower, that means stock prices are going up. So a little bit of win-win for any investor.
And a chance to lock in those dividend yields on your cost basis now, and something we're going to talk about that can supercharge your returns over the long term. I'm Jason Hall. This is Investing Unscripted. He's Tyler Crow. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. Take the time, check out the link. You'll be glad that you did. Tyler, how about you kick us off?
Sure. So I'm going to go to the oil and gas patch because oil and gas or oil prices are a little bit lower. People are probably a little nervous, which means yields are high. I'm going to go with MPLX. Name and ticker are the exact same thing. Specializes in pipelines and gathering and storage and all of kind of the infrastructure and transportation that takes something from the wellhead to a refinery or to the gas station or petrochemical refinery that it's used at. One of the things that has always impressed me about MPLX, in particular, after a corporate change that they had a few years ago, which made it much more shareholder friendly, is that the business is majority owned by Marathon Petroleum, the oil refiner. And so it's kind of run as a subsidiary that throws off a lot of cash to the parent. But what's been so good about it in particular is the way that it's run. It's run in a way such that it spits out way more cash than what it pays out to investors, which is pretty uncommon in this space. All too often, there's a lot of companies in oil and gas transportation that tend to pay out everything they have at the end of the quarter and doesn't leave anything left. By comparison, this past quarter, MPLX had what's a distribution coverage ratio, which basically means like how much cash that came in the door to cover a payout versus what was actually paid out was 1.6 for the quarter, which is quite generous, leaving a lot of cash left over for investment in growth, as well as I think a little bit of share buybacks. So you kind of have that built onto a stable business that more or less what matters with this business is the volume moving in and out of the system versus the actual prices. It tends to take fee-based income to move product for somebody rather than actually taking on the pricing risk involved with commodities. So you get a much more steadier, more predictable revenue flow, allows a business to make very predictable long-term investments. And admittedly, growth has been quite slow for oil and gas pipelines over the past several years, mostly because during the shale boom, we built so much, we're a little over capacity right now. But we're starting to see an uptick in activity. The business has been, our MPLX just authorized the expansion of a couple of its long haul pipelines, especially for natural gas out of the Permian Basin. So there's a little bit of upside in terms of growth, not huge. But for a business that has a dividend yield or distribution yield of 7.6%, you don't need a lot of growth at that sort of level. And that's perhaps what makes this thing so attractive right now is this is a business that's grown its dividend at a quite reasonable rate over the past 5 years or so. Over 5 years, it's been, or 10 years, excuse me, it's been about a 10% annual growth, which, toss that on to a 7% yield. That's pretty good long-term growth. And if we were indeed to see interest rate cuts, which is very possible, you're going to see slow growth, high yield businesses like this likely trade for lower yields and higher prices because it's the marginal yield that you get for this product is considerably higher than the risk-free rates that you would get on bonds or something else where we're going to see lower yields there.
We're already seeing that start to happen in money market accounts with those T-bills, those short-term treasuries are resetting at lower rates based on the Fed cutting its rates. For Fidelity, for example, the money market account of Fidelity has dropped from just around 5% to below 4.5% just in the past couple of weeks. So we're seeing that happen in real time. It's not just bonds adjusting lower, and it's not just equities moving higher and pushing their yields lower, which we've seen that with MPLX as the market has come to realize that this is a pretty good quality business and that yield is very protected and very sustainable. But also those cash positions a lot of investors are sitting on, it might be time to think about redeploying them into places where you can get better yield and you can lock in that yield on your cost basis. And potentially, like with MPLX, you can get the dividend to grow, right? Let's see a bond do that. You don't get that, right? When you start investing in bonds, especially in a falling interest rate environment, your bond ETFs or bond mutual funds, you might see some appreciation in the value as rates go down. You own those longer dated older bonds. But right now, companies like MPLX are just really great opportunities. I'm going to shift into something that's a lower yield, Tyler, but I think we can still bucket it in the high yield bracket based on comparing it to other equities. So this is Rexford Industrial Realty, ticker REXR. It yields about 3.3%. I've got a chart here showing the past 5 years, and you can see that that is still some of the highest yields that it has ever paid. There's a couple of factors behind that yield, and that's the dividend growth. It's up over the past 5 years. The dividend's up more than double, 126%. But also the stock hasn't done exceedingly well more recently, Tyler, and that's because of concerns about its core business and some impacts of some things happening across the Pacific Ocean that are concerning. So Rexford Industrial's business is owning industrial real estate in Southern California. They're in that core market. They're a specialist. They know that market exceptionally well. They've got, I don't know, some 700 buildings in that market and a ton of tenants. And where the Southern California market is really important for industrial real estate is the ports. So many goods come in from Southeast Asia and China and mainland China that are then either distributed into North America or go into light manufacturing facilities. There is a ton of assembly and manufacturing that happens in Southern California. People don't realize that happens, or it hits these distribution centers and is then distributed across the various channels. Of course, concerns with China's economy slowing down.
Well, I was just going to throw in a nice little statistic for you. 40% of all container ships in the United States touch the Long Beach port. So this is the area that moves almost all or a significant portion of cargo going into the United States.
Yeah, that's exactly right. And this has been a wonderful grower for dividends and a wonderful returner for investors. 18% annual average dividend growth over the past 5 years. The key to me for that is, again, I want to bring this chart back up. In this interest rate environment, unless you've already bought bonds and you've locked into those specific bonds, we're going to start seeing yields fall more, which means that the income streams from those bonds is going to start to reduce. You might get some capital appreciation on the bonds if you sell before they mature, if you've got bonds that you've locked in at a higher rate. But again, with a company like Rexford, follow it closely, make sure you know what you own, make sure they continue to execute. But when they execute like this and you get those double-digit growth every year, again, even though the yield today might only be 3%, if they're bumping that 10 to 15% on an annual basis, that's going to put you in a really good position if you're an income investor or you're looking for total returns. And kind of like with MPLX, you were talking about, Tyler, where that high yield and the ability to grow that payout over time sets a really high floor for what you can expect for returns. If we see the bull market with stocks continue and the market just continues to rip, maybe they don't beat the market. But if your goal is less about beating the market, but getting above average total returns than you could get from fixed income like bonds or in cash, these can be wonderful, wonderful investments to own. And I think right now, Rexford, the way it's priced, the quality of its business, sure, there's some macro concerns right now, but I think if you think about it long term, a lot of those concerns with China are going to make those properties just as value as we see more nearshoring happen and more focus on developing assets inside the US and inside North America with our trading partners. I think those assets are going to continue to be exceedingly valuable because the infrastructure is already there, right? And we shouldn't discount the value of that no matter what happens with China over the long term. So I think Rexford right now absolutely fits this category of stocks that are worth buying right now if you're looking for that yield, especially if you want to get the dividend growth.